Hello everyone, thanks for checking out my video. If we can use images to summarize the US stock market in September, I would say this will be the first, and then this will be the second. Anyway, last Friday marked the end of a brutal trading month and quarter for investors, with S&P 500 and Nasdaq clocking their worst month in 2023. So what's the market outlook for October and till the rest of the year? I have some statistics to share with the viewers. Also in this video, I will be showing you a live option trade that I have made and recorded last week, as well as a summary of my September's option trades. Therefore, please watch till the end of the video. Last Friday, the unspoken Federal Reserve's preferred inflation matrix, also known as the PCE price index, gave the market a positive news. The latest reading, excluding the volatile food and energy prices, rose 0.1% in August and 3.9% annually. This is slightly better than the analysts' expectations. But unfortunately, the market saw a reversal before the closing bell on Friday as investors were concerned about a potential US government shutdown, which could impact the economy and affect consumer sentiment. However, at the time of recording, fortunately, the Congress had passed a short-term 45-day funding bill ahead of a critical deadline, thus preventing a government shutdown. The bill will keep the US government open till 17 November, but does not include new financial assistance for Ukraine's ongoing war with Russia. Anyway, prior to last week, the stock market was already weak for almost the entire September. So at the end of the month, the S&P 500 was down 4.9% and was 3.7% lower for the quarter. The Nasdaq dropped 5.8% for the month and down 4.1% for the quarter. Finally, Dow Jones declined 3.5% and 2.6% for the month and quarter respectively. Well, September had truly lived up to its bearish reputation. In terms of market outlook, for the shorter term, let's see how the market reacts on Monday after the government has avoided a shutdown, though the Congress could be back in the same situation in 45 days' time. Given that the market has been oversold in September and that October is the start of a strong quarter, plus we have good news from the PCE data and US government, we could maybe just have a little bounce this week. Not financial advice, okay? Meanwhile, Tesla is expected to report their Q3 production and deliveries before the market opens on Monday. Analysts are expecting the company's deliveries to fall from Q2's number, which was around 466,000. Production-wise, it is also expected to fall quite sharply due to Tesla's temporary shutdowns and generally slowed output. Similarly, I will be interested to see how the market reacts to the numbers. Finally, we have a FOMC meeting at the end of the month, specifically on 31st October and 1st November. Closer to the dates, there will be lots of talks about whether we are going to have another rate hike or not. Therefore, expect some volatility in the last week of October. In addition, pay attention to the various economic reports that will be coming out this month, such as CPI, job data, unemployment data, etc. Okay, moving over to the technical analysis. Starting off with SPY again. SPY is currently sitting at a crucial area, marked by the green dotted uptrend channel line, as well as the 38.2 Fibonacci retracement level. In fact, SPY broke below these two levels last week and was trying to break back above them. Once again, this is what I called a retrace and retest, which I have shared before. Therefore, for this week, watch how SPY reacts to this retesting of the two key levels. If it gets rejected, and if it starts closing below 426 for say about 2 days or so, then I would say there is a high chance that it will continue to head towards that gap at around 419 to 420. Okay, here's the interesting thing. From what I understand, or at least based on my sensing, many traders or institutions are watching this area or the level 420 quite closely. So if that breaks, I would think all hell will break loose. Algorithm trading may be triggered and paper hand investors may start dumping their shares. The next level of support below 420 would be around 416 to 417, formed by the next Fibonacci retracement level as well as the 200 moving average. For your information, from the peak of 457.8 to 416, it's a 9% drop, and that's very close to a correction in the stock market. Okay, for viewers who are not aware, a pullback of 10% or more is called a correction, and a 20% decline from the top will bring us into a new bear market. But let's say the stock market put the September slump behind us and SPY passes the retest of the two critical levels, the upside potential is actually quite a fair bit. I mean, if you zoom out the chart, technically speaking, SPY has room to run up till the top end of this uptrend channel. But this of course will not play out in 1 or 2 weeks. If anything, it may need till the end of the year. Therefore, realistically speaking, if we are only looking at October itself, if SPY can hold above the two important levels, we could at least move towards the middle of the channel. That's about 450s range, which coincides with the gap at the top. From the current price of 420s to the mid-channel range of 450s, that's a 30-point upside. So if you can ride this trend, I think you can profit quite a fair bit. Meanwhile, just to highlight, we did something similar in March this year. SPY went below the green dotted channel line and even went below the 200 moving average, but it recovered quite nicely back into the middle channel before grinding up to the top end of the channel. Will it happen this time again? We shall see. Let's now move over to Apple. In my last video, I shared that Apple has been consolidating in a tight range, and 172 has acted as a decent support. I also shared that breaking below 172 gives us a high chance to fill the gap between 166 to 170. Well, Apple broke below 172 but did not fill the gap entirely, but it was almost there, because currently the gap there is left to be filled is between 166 to 167. As we approach the end of last week, we can see that Apple is trying to get above the earlier support of 172. Therefore, this week, watch this level again. Watch if Apple can succeed in reclaiming this level. I would say 2 green solid candles or about 3 candles of any colors with higher lows above 172 would be an ideal case for the boost. In my personal view, for Apple to be claimed to be bullish, it has to get out of this consolidation area, which ranges from 173 to around 180. Okay, I know it's a long shot, but if we can break above 181 say in the coming weeks or in the month of October, it's super bullish. Because above 181 means Apple would have reclaimed the important 61.8 Fibonacci level as well as the 50 moving average, which currently sits at 181. And not just that, above 181 also means that the gap down that was created in early September will have been filled. That said, on the flip side, with so many key levels falling at this area, do expect some sellers to step in at around 181. On the other hand, if Apple could not even get above 172 this week, it's actually quite bearish in my opinion. The longer it stays below 172, the higher chance we may head towards the red dotted downtrend line, where the current 200 moving average is sitting as well, at around 165 to 166 area. And don't forget that little gap that I mentioned earlier, around 166 to 167. So in short, to sum up the bearish thesis of Apple, this area of around 165 to 167 is very crucial. I repeat, it's really important for Apple to stay above the 200 moving average. The last time Apple was below this level was in January 2023, which was the start of this 2023's bull run. So, I mean, if Apple is facing a sell-off and closes below its 200 moving average, I am not sure how resilient can other big tech stocks be. Alright, hopping over to Tesla. Well, if you have been following my videos, you would know that the 61.8 Fibonacci level is always a critical level to watch. And check this out, Tesla bounced off this level so nicely after testing it for 3 days. That's a good sign. But there's always a but. Before the bulls get all too excited, can you see this Friday's candlestick? It's called the long-legged doji candlestick. The The candlestick shows that there is indecision in the market for Tesla stock right now. Okay, to put it in simpler terms, it means there was a battle between the buyers and sellers last Friday, but ultimately they ended up about even. I suspect it could be because Tesla is reporting their delivery numbers this weekend. Anyway, if you have learned something to this point, please give this video a thumbs up. Meanwhile, at the time of recording, I don't know the results of the delivery numbers yet, but I believe come Monday, we can expect some huge movement in Tesla. However, just wanted to say this is just a short-term volatility. Bulls should not be too complacent if there is a sudden surge on Monday. Likewise, bears should not be too excited if the stock plummets. One day does not make a trend, so let the stock settle in the next few days and then we try to identify the new trend. Okay, so what key levels should we look out for to determine the trend? Well, before I dive into that, I just wanted to thank the viewers that I actually got 50 likes for my last video. It may not mean a lot to others, but it does mean something to me because that's the most likes I have ever received for any videos, and I do appreciate it. Meanwhile, I am just about 70 subscribers short of the small little milestone of 1000 subscribers, so please help to like and subscribe if you have not. And if you like the free content that I put out on a weekly basis, you may consider buying me a cup of coffee via my coffee page. I would be really grateful. Okay, back to business. In terms of the upside, Tesla has kissed this resistance level or area of about 253 to 255 last Friday. I would say this is the first hurdle that bulls need to cross this week. But because Tesla is so volatile and it's reporting its numbers over the weekend, a spike above this level is nothing in Tesla's context. For me to call the trend slightly bullish, I would want to see Tesla going above the long-term red dotted downtrend line again. And in the process, to fill that gap between 260 to 262, followed by reclaiming 263 level. When all this happened, then I would say Tesla is slightly bullish. But why I don't call it very bullish yet? Well, if you zoom out the chart, you will see that Tesla broke above the downtrend line previously, but fell back down each time it retraced and retested the line. Therefore, in my view, if you want to see Tesla hitting 280 or even 300, it has to break above this downtrend line, retest it, and then bounce up convincingly. In terms of the downside, similar to what I have shared in my last video, 238 will act as a decent support. As you can see, Tesla tested it 3 times last week, and the bulls managed to protect this level. But if we start seeing Tesla closing below it for 2 days or so, then bulls have to be very careful because the probability of it falling to 220's range is relatively high. To be more specific, we may just head towards this green dotted uptrend line. To add on, as I have previously shared, market makers don't move the stock so nicely to a certain point or support line, so don't be surprised if we break below the green dotted line a little bit and fill that gap at around 217 to 220. Finally, let's say somehow Tesla starts to fall towards the recent low of 212, or worse still, start hitting the 200 moving average at 205, that's super bearish. When that happens, I think below 200 could be in sight. Finally, let's check out Google's technical chart. Google, in my view, is quite straightforward. There are 2 consolidation zones from July till now. First is this area between 127 to 133. An area that I have been sharing for weeks. Second, it's this 133 to 139 area. But if you want, you can also group both areas together, which then ranges from 127 to 139. With this, it means that if Google falls below 127, it is breaking this consolidation trend that started in July, which also means the trend would have turned a little bearish. Below 127, the first area to watch will be none other than the huge gap between 123 to 126. Once again, market makers don't set things up so nicely for you and me, and the gap may or may not be filled entirely, so we need to dive in a little bit more. Within this gap, there is this critical 61.8 Fibonacci retracement level at 124, and coincidentally, the 100 moving average is also sitting within the gap at around 126. So yup, if Google fall to this gap area, watch for these 2 levels. if they break, then I think we could slide down all the way to sub 120. In terms of the upside, it's quite obvious that Google is trying to reclaim that 23.6 Fibonacci level towards the end of last week. So let's see if it can finally break above it this week. Breaking above it will then put us into the top consolidation zone. From here, the upside potential would then be 139 to 140 area. Alright, let's now move over to the option trading segment. So as shared in the opening of this video, I have recorded a trade that I opened last week, which is a cash secured put on Apple with a strike price of 160 expiring on 3rd November. But before I show you the video, let me share why I made this trade. So on Tuesday, 26 September, I saw Apple was testing the recent low of 172, and prior to this, it went close to this level on about 7 occasions, and somehow it did not get breached. So at that point, I saw it as a decent support, and hence I entered the trade. But of course, in hindsight, I could have waited for another day or two as Apple broke below this 172 level, and that could have fetched me a better premium. Then again, hindsight is always 20 out of 20. I mean, who knows, if 172 has broken, I may not have stepped in. Anyway, Apple rebounded back on Friday and my trade is currently in a small green zone. And oh, if you realize, usually for newer trades, I will cover up my premium so that viewers do not follow my trades blindly. But I did not cover it this time because I'm gonna show you the live trade video later. So you will be able to see my premium anyway. But again, please do not follow my trade blindly, okay? Alright, just to add on, in terms of my strike price selection, I chose a strike price that I thought it was relatively safe, at least in my opinion. Sorry if the chart looks a little messy, but can you see the blue Fibonacci retracement levels? I chose 160 because it gives me quite a bit of buffer. I mean, for Apple to hit my strike price, it has to break the recent low of 172 and further retrace past 3 Fibonacci levels. Not just that, it also has to close below the 200 moving average as well as the long-term red downtrend line. So if Apple really breaks below this 4 to 5 support levels, I will be like, fine, take my money. I will take the 100 shares if it is assigned to me. But of course, I could also roll the options to avoid assignment. Alright, so here's the recording of my live trade. So last Tuesday, Apple was falling rapidly during intraday, and after I have done my due diligence, I went to the option page, select 160 strike price, click on trade, and I went with $2.05 for the premium. I then enter my password, click on continue, and then click on confirm, and order submitted. The trade took about 2 minutes to get filled, so I'm just gonna fast forward the video. And there you go, 3, 2, 1, filled. Okay, the second trade that I opened last week was a cash secure put on Tesla with a strike price of 195 expiring 3rd November. The trade was opened on Wednesday 27 September and within 2 days it is already up by 42%. So there are 3 main reasons why I opened this trade. First of all, Tesla has touched the bottom of the Bollinger Band, which gives it some chance to bounce up in the next few days. Secondly, the 100 moving average has served as a decent support at the start of last week. Thirdly, I am of the view that this 61.8 Fibonacci retracement level is a strong support, which is at 238 level. But it doesn't mean that Tesla will not break below the 2 support levels. This then brings me to the next point, risk management, one of which is the selection of strike price. As shared earlier in the technical analysis segment, below 238 there are multiple support levels, namely the green dotted uptrend line, the recent low of 212, the 200 moving average, and the last one, which is the Fibonacci retracement level at around 196. Alright, September has come to an end, and if you recall, I mentioned in at least 2 or 3 of my videos that my plan for September was to sell cash secure puts and wait for a potential recovery in October or November. And I did what I say. So here's a summary of my September trades, a total of 5 cash secure put options, expiring either end October or early November. And if all contracts expire worthless, the full premium that I get to keep would be $932, which is about 1,000 to Singapore dollars, after deducting the trading fees of course. Not too shabby for so-called coffee money or passive income. Alright, some quick end thoughts for this video, but before you drop off from this video, here are some quick interesting stats to share, courtesy of Yahoo Finance. Check out the image on the right. Basically, it shows that when January to July is bullish for a particular year, followed by a bearish August and September period, we tend to have positive gains for the final 3 months of the year. This actually happened on 7 occasions, and the average 3-month return for these 7 years is 9.6%, with a median of 7.9%. To add on, each of the individual months had displayed decent bullish momentum. Back to last Friday, in my opinion, the market was actually trying to rally but got affected by a potential US government shutdown. Now that this issue is temporarily out of the way and that the technical charts are a little oversold, a bounce in the stock market could be on the cards. But that's just my view, and I could be wrong. Ultimately, the bears will highlight some of the headwinds that have surfaced quite recently, such as gas and oil prices rising, union auto workers strike, resumption of student loan repayment, higher for longer interest rate, and fewer rate cuts in 2024. Other than this, the Fed is still not done with their fight against inflation. Don't forget, their target is 2%. Speaking of all these headwinds, I find it quite interesting that the market was kind of worry-free just a few months ago, cheering for easing inflation and a potential soft landing by the Fed. But look at August and September, and now, suddenly the wall of worry is forming again, and the fear and greed index even hit extreme fear at one point last week. Suddenly, investors and traders are feeling fearful and uncertain again. All being said, again, my view is that all this negative news are just noises. It is important to filter away some of these irrelevant noises and focus on your investment or trading plan. For me, I have picked up S&P 500, Microsoft and Tesla over the last 2 weeks, and I also stuck to my option trading plan, which I have shared earlier. Actually, I am quite curious if any viewers have picked up any shares in September. Would be great if you can let me know in the comment section below. Meanwhile, please remember to tap the like and subscribe buttons if you haven't, and I will see you in the next video. Thank you.